Welcome to Investors Guide. You're watching ET Now. This is a show that helps you find all of the investment products in the market that suits your portfolio best. Remember, you can write to us with any question you have about your money. There's an email ID at the bottom of your screen. Before we go any further, a couple of things I should let you know about. We have the Managing Director of CIBIL, or the Credit Information Bureau of India, who's going to be in the studio next week. So if you have any questions about your credit report or your CIBIL report, as it's called, write to us on the email ID on your screen, and we'll ask him those questions when he comes in. Of course, a quick reminder of our new show, The Property Guide, that's on ET Now, brought to you by the same team that does Investors Guide every week. These are the timings of that show. You can catch it and ask us any questions you might have about buying property. Let's get straight to it. On the show this week, we'll find out if it makes sense to invest for your child's future before you buy any insurance. In our product review, we look at the Franklin India Prima Plus Fund, and we'll tell you how to create a retirement corpus of 1.5 crore rupees. All right, let me bring in Virendra Kumar, the CEO of Value Research and our in-house mutual fund expert, who joins us on this show every week. Virendra, thank you so much for joining us. Let's get straight to our portfolio versus portfolio question. Well, 35-year-old Amol has written in, Virendra. He writes in from Mumbai. He has a 5-month-old daughter. He's planning on having another baby over the next 3 years. Amol, we're really happy that you're managing the plan ahead so well. Virendra, he has a monthly take-home of 60,000 rupees, and he tells us he recently purchased a home in Mumbai that's drained out all of his savings. We understand what that might feel like. Now, he tells us right now he has 2,000 rupees going into his PPF and 9,000 rupees going into a ULIP every year. This is the worrying part. No insurance, no term cover, no health insurance, no mutual fund investments. He has a lot of goals, but before I get into that list, Virendra, do you want him to focus on his insurance first?
That should be the topmost priority. He should get a term cover for himself and little liberal one, because he has no savings or accumulated savings or investments. That apart, his need for term cover goes up because he has bought a house, and the house should be held by the family if he's not around. So getting a home loan term cover, where your coverage actually goes down as and when you have paid a part of your home loan over time. So that should be your topmost priority, and a health cover for yourself, because you will never get started with your savings. And then comes, as and when you have surplus after this, then you should think in terms of how to approach it. And from that standpoint, I think that your PPF investment is not a very desirable first investment to start with. All your goals are 15, 20, 25, 30 years away, and PPF is a fixed income investment, though safe, but it will yield something which will not even beat inflation.
So, Amol, this is the thing that worries us about your portfolio. If something were to happen to you, your entire family is dependent on you, you leave them with a massive home loan and no savings to pay off any of those loans. So like Virendra said, what you first need to do is get an insurance cover on your home loan, then get yourself a term insurance cover, and make sure your entire family has health insurance so you don't have to dip into your savings in case of an emergency. And Virendra, in terms of a mutual fund, could you give him a starter's mutual fund kit that he can use now that he's going to be making his first mutual fund investment?
It should be, one of the funds from our stable growth portfolio, balanced fund. And it's not a bad way to start. He will develop a belief. And anyway, his goal is 50, the minimum time frame for his earliest, goal is 15 years. So he has the time, but I would still like a person like him to get started with a very conservative approach, and then in 2 to 3 years' time change track as he develops his faith.
Right, if you'd like to have your portfolio looked at, email ID is at the bottom of your screen, and we don't have to remind you that we're especially partial on this show to women investors. So also women who are watching, feel free to write in. Okay, we're going to take another question that's come in from Harit. He's 22 years old with an income of 7 lakh rupees. And he tells us he invested about 2.5 lakh rupees in fixed deposits and another 50,000 rupees a year in a money-back policy from LIC. He wants to now begin investing in mutual funds that will give him a strong annualized return. He's only 22, Virendra, which means that he has a really long way to go. First of all, 2.5 lakh rupees in fixed deposits and some money in a money-back scheme, so that's largely debt. How would you like him to get started?
I would say that he can well consider a good part of it, which is 2.5 lakh rupees going into a fixed deposit. It's not a bad start. I would look at it as an emergency fund. That is the money which he can draw upon any time. It is safe, and today it is also yielding reasonable return. But of course, it will not beat inflation. It's very important for investors to understand today that today what you see is as 9.5%, 10% return. The worth of your money will actually be lower 3 years, 5 years down the line when your FD matures. So, even though, because inflation is more than 10%, 50,000 going into money back policy may not be the smartest move or may not be a wise investment. I would say that somebody like him should get started with an aggressive portfolio and assuming, thinking that, one is not convinced, then maybe at least with a stable growth portfolio, he will have 70% allocation to equity, he'll be investing regularly, he'll be having a diversified portfolio, reasonably diversified portfolio, and he will not be upset with a decline in market.
So this is something we can all learn from. If you don't have an equity portfolio right now, Dhirendra is saying that this is a good opportunity for us to start when the market is slightly soft, so you don't regret it later. And of course, the same advice again, our stable growth portfolio is on your screen. If you're starting off and making your first investment, any one of these funds would be a good way to go. Alright, we have time for one more very quick question. Ramesh has written in, he's been investing in the Franklin India Flexi Cap Fund, Dhirendra, 1,000 rupees a month for the last 6 years. So there is something to be said for that persistence in this tough time that we've noticed in the market for the last 5 years. He wants to know now if he should continue that investment. Now, as far as the Flexi Cap Fund is concerned, Dhirendra, what's your call on that fund and should he continue investing in it?
I would say that he has carried on through the very difficult period of the market and he should carry on. Of course, it's not the finest choice because Flexi Cap, if we have to compare it with alternatives, there are superior options available. But I think, this kind of disciplined investment, you make investment every month for last 6 years, the difference won't be very substantial. Even if you would have chosen the finest fund, today the difference in return or the terminal value, all the accumulation will be 1 to 1.5%. So I would say that he should carry on for the sake of he's comfortable with it. But there are superior options, maybe, a Prima Plus or UTI equity should be a better bet. But I would say that for the sake of continuity, and he has carried on, he should carry on for, if he has 2, 3, 4 years time, he should carry on and certainly not get distracted at this point of the level of the market.
Time for a very quick break. Dhirendra is going to stay with us. When we come back, we'll talk about the Franklin India Prima Plus Fund. Don't go anywhere. Welcome back to watching Investors Guide on ET Now. It's time for our product review, and this week we're looking at the Franklin India Prima Plus Fund. Avan is here to give us a quick introduction. Avan.
Thanks for that, Faith. Well, known for its consistent track record, our fund under the scanner this week is the Franklin India Prima Plus Fund. Launched in September 1994, this fund follows a blend of value and growth style of investing and takes concentrated bets only on certain stocks. It invests around 60% of its portfolio in large caps and puts the rest in mid-cap stocks. It has outpaced the category average in both the bull as well as the bear phases of the market and has managed to curtail its losses better than most of its peers. It has been part of the top 2 quartile most of the time in the last 9 years. And its long-term returns also don't disappoint, as its annualized 10-year return of 18% is higher than the category average. But let's do some math to give you a better point of view. If you invested 1,000 rupees in this fund when it launched, you would have 23,746 rupees today. So should you remain invested in this fund? Our experts are here to give you the answer. With that, it's back to you, Faith.
Alright, Avan, thank you for that introduction. Dhirendra, the Franklin India Prima Plus has a very interesting blended method of fund management where the fund manager is not in any way stipulated that he has to invest in maybe large caps or mid caps or small caps. Do you think that this type of fund management has worked for the fund?
I think this kind of fund management is the only thing which works over a long period of time. Because any fund which gets focused on small caps or large caps or mid caps is unlikely to be very consistent. And most investors want a very simple solution when they are choosing a fund, that it should be doing reasonably okay most of the time. If investors don't want to be very proactive with their fund selection, moving back and forth, making allocation to large cap, mid cap, small cap, or monitoring that, then this is the most desirable kind of fund. And in fact, even in our shows, we keep telling that get into a fund which does not have which has a broader mandate, not a very narrow mandate, and fund manager has the flexibility, and this is just a kind of fund. This fund has also been part of many of our portfolio exactly for that reason.
Well, Virendra, how would you rate the stock picking on this fund so far? It tends to be a little different from its benchmark. It tends to pick stocks that it wants to bet on. How would you rate the fund management?
I would say that, over a long period of time, this fund was very impressive. Last few years, it has not been impressive. The fund does very well when the market goes up and has a meddling performance when the market is struggling. And that is what we have seen in all the, lean period or the peak period, when the market was doing very well.
Well, Virendra, the last time we reviewed this fund, you gave it 4 stars. How would you rate it this time?
I would assign it a 4-star once again, exactly for the same reason that the fund, by its design, by its structure, and by its process, is good. The performance has also been above average, but it has not shown its brilliance in stock picking or with its stock bets in recent years.
4 stars for that fund on Investors Guide. Now, if you would like us to review a particular fund that you've invested in, write to us. Email ID is at the bottom of your screen. It's time to move on to our rapid fire hold or sell segment. Raj has written in Virendra. He's 30 years old. He's been investing in mutual funds to create a retirement corpus, which means that he has at least 30 years as a time horizon. He wants to know if his investments are on track. Right on top is the BSP BlackRock Top 100 Fund. Now, for something that is so specific to the top 100 stocks for the next 30 years, does it make sense?
Top 100, excellent large cap fund, but not a suitable fund for his time frame.
Well, yes, the IDFC Premier Equity Plan that's also on his list, along with the HDFC Equity Plan, Virendra. These are more the flexible plans that we were talking about. Would you recommend he continues investing in both of them?
Yes, he should continue investing in both of them, and for their flexibility and also their reasonable performance.
The next on his list is the Sundaram Select Mid-Cap Fund, Virendra. Makes sense to add a mid-cap fund, but is this the best choice available?
It is a good choice. Of course, all mid-cap funds are out of favor right now. This fund has all the hygiene, all the variables, and also has the experience. I would say that one has to wait for the market turnaround for these funds to perform.
The next on his list is the Morgan Stanley ACE Fund, Virendra. We don't see this in too many portfolios. Would you recommend he continues investing?
It has been an impressive fund. It is much, it has shown far superior performance than the oldest fund of Morgan Stanley, the Morgan Stanley Growth Fund. And this is a multi-cap fund. It can invest anywhere. It's a decent fund, but has seen, limited history, and it has seen big upheaval.
Well, the next one on his list is the ICICI Prudential Dynamic Fund. You recommended this fund plenty of times on this show. Would you recommend he continues that investment?
Yes, ICICI Prudential Dynamic is a very impressive fund. What this fund has been able to deliver across, in any kind of market is very impressive. One should carry on.
We'll take a few tax-saving funds together, Virendra. There's the L&T Tax Advantage and the Principal Personal Tax Saver. Now, they're possibly not out of their 3-year lock-in, but going forward, if he's making investments to save tax, are these the 2 best options?
Both funds have done reasonably okay. I think the framework for choosing a tax-saving fund should be either if you can withstand great volatility, and you have, the lock-in period to support that, because once you invest, you can't do anything about it, so might as well take the volatility and get higher return. And so choose a fund which is into small caps, mid caps, take bets into illiquid, relatively less liquid positions to maximize return, and that will come with its risk. But if you have time on your side, or if you can withstand that, that could be hugely rewarding.
There are 2 more funds on his portfolio I'd like to tackle. One is the Reliance Gold Savings Fund. He's investing 2,000 out of the entire 28,000 rupees that goes into these funds every month. He also has the DWS Ultra Short-Term Fund. There's 8,000 rupees going into that fund as well. Of these 2, which one should he hold on to? Does he need them in his portfolio, considering he has a 30-year horizon?
I would strongly urge him not to invest in the gold fund, because unless until he has some personal preference, I'm not very optimistic about a gold fund or investment in gold over the next 30 years. DWS Ultra Short-Term Fund should be there only if he has chosen, if he has, earmarked or decided on an asset allocation, and this 8,000 rupee investment is going as a fixed income allocation. If this is not so, I think 8,000 rupee of his total investment going into fixed income is a very high allocation for a 30-year time frame.
Alright, so on your screen right now are the funds that Dhirendra has recommended you do keep in your portfolio. And of course, good luck with that long-term horizon, and write to us if you have any more questions. We have a couple of more questions. Ajay has written in, he's been investing on behalf of his wife and his mother for their tax-saving needs in the Franklin India Tax Shield Fund. He's happy with the returns he's received and the dividends he's been receiving from those funds. He wants to know if he should continue using that fund for his tax needs. Dhirendra, what would you recommend he does?
It's a good fund to have. But I would like to warn him one thing, that don't be pleased with the dividend, because when it comes to dividend from mutual fund, you can invest 1 lakh rupee and you can feel happy that next after a couple of months you got 10,000 rupee back. That is nothing. That may not be necessarily growth of your money. That may not necessarily be earning from income from your investment. You just may be getting a part of your money back, because the worth of the remaining investment which remains, that might get down to 90,000 rupee and you got your 10,000 rupee back in the form of dividend, and you will be pleased about it, while there is no reason for you to be.
Be careful of that dividend option. Of course, you can consider the growth option, which will allow you to multiply that money. I have time for one more question, Dhirendra. Satish invested in the DSP BlackRock Top 100 and the L&T Equity Fund, and he wants to redeem his investments because of poor performance. He wants to know where else he can put that money instead. First of all, would you recommend that he pulls his money out of these two funds? And if yes, then where should he be investing that money?
No, I would like to know more about why is he disappointed. He is disappointed because these funds have not done well. When did he invest? Or what is the reason for his disappointment? Because there is a possibility that if these two funds are reasonably well-performing funds, and if you look at 3-4 years, depending on the time you invested, one can well be disappointed by any equity fund one would have invested. DSP Top 100 is a relatively better off category per se, because the decline in value of the large cap fund is much lower. So I would say that if he's looking to switch to enhance the return, it's important to invest, it's important to understand the reason. I would say that the way to marginalize his disappointment will be invest regularly, never invest lump sum, and choose funds which are not necessarily like DSP Top 100, which is a good large cap fund, but be in a fund which is diverse and low maintenance, can invest across. So
when you say low maintenance and can invest across the market, Dhirendra, can you give him a couple of options that he could use?
Something like ICICI Prudential Dynamic or UTI Equity Fund. These are funds which can invest across the market, in all large cap, mid cap, small cap, and they are not necessarily tied down to a specific segment of the market.
Alright, on your screen right now are the few funds that Dhirendra recommended you can use if you're making those long-term investments. Dhirendra, thank you so much for joining us on the show and answering all of our questions. We look forward to sitting down with you again next week. Coming up after the break, we'll find out how you can create a retirement corpus of 1.5 crore rupees. Stay tuned. Welcome back. You're watching Investors Guide on ET Now. Thank you so much for staying with us. I want to bring in Gaurav Mashruwala right now to answer all of the questions you sent in on asset allocation. Gaurav, thank you so much for joining us. Pradeep has sent in a question, and he has a goal to buy a home over the next 2 years, and he also wants to create a retirement corpus of 1.5 crore rupees. And he has a monthly income of 38,000, and the only savings he has right now are going into his ULIPs. He wants an investment plan. Gaurav, can you help him out?
So Pradeep, here it is. Since you want to purchase a house in next 2 years, what you should be doing is a systematic investment plan into a debt-based mutual fund or do a recurring deposit. The reason I'm recommending this is while your returns may not be better than inflation, but since goal is so near term, what you want to ensure is the intactness of principal amount. Your principal should remain intact. So keep doing that. And at the time of purchase of home, use that corpus to make a down payment, and for residual amount, take a home loan. Now, your retirement is concerned, that I'm assuming is going to be fairly long because you are in your 30s. And for that, once your home loan issue is settled, you want to start doing a systematic investment plan into an equity-based mutual fund. You can start with an index fund, and over a period of time, as you get confidence, you want to move to actively managed large cap funds and then even mid and small cap funds. Keep doing it on regular basis to accumulate corpus for your retirement.
Our next question comes in from Arun, who has 14 years to retire and he can currently set aside about 20,000 rupees every month. He has a 16-year-old son and a 13-year-old daughter. He wants to know how he should allocate those 20,000 rupees so he can also look after his own retirement and his children. Gaurav, what would you recommend he does?
Arun, yes, little late in life, but that's perfectly all right as long as you have realized that and you have started, better late than never. Here are my recommendations. You're talking about your own retirement which is nearing, you're talking about your children's education as well as marriage. Now, you'll have to prioritize. So, and that's what you and your family will have to decide based on priority. If retirement saving is your priority, you may want to do a systematic investment plan into equity-based fund and also a parallel PPF, unless you have an EPF, Employee Provident Fund, from your employer. Now, if you're saying your priority is education, which means you want to fund the education and not go for education loan for your children, then you may want to go for debt-based instrument because your children are 16 and 13 years old. And hence, higher education requirement will come in next 2 to 3 years where debt-based mutual funds could be a solution. If marriage is your priority, then again you can look at an equity because marriage, I assume it's going to be a decade away. So prioritize your goal and then choose an asset class and then go for mutual fund. You may also decide that you may want to fund all three, and in that case distribute a surplus in proportionate basis in equity and debt-based mutual fund. You may also want to pick up a gold-based mutual fund because at the time of marriage you may require gold, so then you can liquidate gold fund at that point of time and use money to purchase physical gold.
Alright, Gaurav, thank you so much for answering those questions. That's a wrap on Investors Guide. A couple of things we should tell you about before we go. We have the Managing Director of CIBIL, who's going to be in the studio next week. And he's representing the Credit Bureau of India. So if you have any questions about your CIBIL report or your credit report, write to us. Email ID is at the bottom of your screen. We're also extremely partial to our women investors. Send in any question you have. And of course, a quick reminder of our new show, The Property Guide, that's on ET now at these times. If you have any questions about buying property, get in touch with us on that show. Thanks so much for watching Investors Guide. Tune in next week to catch the show.